Welcome to Retirement GPS, navigated by Zynergy, your roadmap to a secure and confident retirement. Each week, we explore strategies, stories, and planning frameworks designed to help you navigate the complexities of life after work. From tax planning to investments, income strategies to risk management, our goal is to give you the clarity and confidence you need to make informed decisions. But retirement isn't just about the numbers. It's also about lifestyle, purpose, and peace of mind. We're here to guide you through both the financial details and the personal dimensions of this next chapter. Let's chart today's course.
Welcome back to the Retirement GPS podcast. I'm your host, Ryan Zacharczyk, certified financial planner and president of Zynergy Retirement Planning. We are on episode number 53 today. Can you believe it? It's been over a year since we started our podcast, and we're going to focus on something a little bit different today. Today, our focus is going to be on the markets, and specifically a question that's come up here at Zynergy a lot lately, and the interest in IPOs. We're calling it IPO fever. Why the hot investments often make the worst investments. The reason why we're going to be discussing this today is because every few years, Wall Street develops a new obsession. Sometimes it's AI, sometimes it's cryptocurrency, sometimes it's SPACs, and sometimes it's the latest IPO, the company that everyone seems convinced will be the next Amazon, Apple, or NVIDIA. And lately, we've had quite a few of our members asking the same question. Ryan, should I buy the SpaceX IPO? Ryan, should I buy the Jersey Mike's IPO? And for some reason, we've had IPOs in the past that people have been interested in. A few of the IPOs lately have really captured people's imagination. And understandably why. It's a fair question. The media covers these companies relentlessly. Friends are talking about them. Financial headlines make them sound like they're once-in-a-lifetime opportunities. They pop up on your cell phone, and you can't ignore them. Today, I want to explain why, despite all of the excitement, IPO investing is one of the easiest places for long-term investors to make costly mistakes. This is because IPOs are bad. I love IPOs. IPOs are what makes capital markets so important and so great. But in general, it's the excitement that doesn't live up to the hype, and the investment rarely makes good partners with that excitement. Let's start with why people become interested in IPO, because humans are wired to chase the new. We just are. When a company goes public, we're often hearing about businesses we already know. Companies like Uber, Airbnb, Facebook, Robinhood, Reddit. These are companies that make products and services that we use every day. And we think we love the product, we love their service, we should own their stock. It seems logical. Unfortunately, being a great company and being a great investment are completely different things. The question isn't whether the company is good. The question is, what price are you paying for their future? See, the problem is the story's already been sold. Here's something most investors don't realize about IPOs is that by the time an IPO reaches the public, that story has already spread and it's already been told. The investment banks have spent months building the excitement. Institutional investors have analyzed it. Analysts have written reports. Media outlets have covered every single detail. The founders have done interviews. Demand has been carefully cultivated. In other words, by the time you finally get to buy the stock, you're often buying it at maximum optimism. And optimism usually isn't cheap. Many people think IPO investing is just getting in early, watching it double, and making easy money. And sometimes that does happen. Of course, there's plenty of history littered with companies that have done that, whether it be Meta or Google or NVIDIA. But most of the time, it doesn't. Many IPOs surge on the opening day and then spend years trading below their initial excitement. History is full of examples. Companies that look unstoppable on CNBC struggled once investors demanded actual profits instead of exciting stories. Some eventually recover, but many don't. For every Meta, there are 2 Snapchats. For every Tesla, there are 3 Rivians. And for every Nike, there are 5 Pelotons. These are companies that came up with huge excitement with their IPOs and have not only dramatically underperformed, but have continued to go nowhere. Every great company can be a terrible investment. This is one of the hardest lessons in investing that most people just don't understand. A phenomenal company can still be a poor investment. Because if you bought Amazon in 1999, right? Amazon, one of the greatest companies in the history of the world, but if you bought it in 1999 near the height of the dot-com boom, were you right that Amazon would become one of the greatest companies ever built? Of course you were. But were you rewarded immediately? Not at all. In fact, you made a very lousy investment if timing is to be accounted for at all. And you might say, well, if I hung on to Amazon for 25 years, I would have done great. Yeah, you're right. You would have. However, all you had to do was buy Amazon 2 years later, and you would have got it at a 90% discount from the price that you would have paid. Amazon lost roughly 90% of its value before eventually becoming one of the world's largest companies. So it would have been the right company at the wrong time. Being a great company is not enough. You also have to make sure that you're paying a reasonable price. If you bought Amazon in 1999, you dramatically overpaid and it took you almost 10 years to get back to break even. Price matters. Let's think of this as buying a house, right? Let's say that there was a house, a beautiful house. Everything was perfect, exactly the way you wanted it, the way you could see yourself raising your family, the way you could see yourself relaxing in the hammock in the backyard. And that house was roughly worth about $800,000. Paying $2 million for that same house isn't suddenly a better investment simply because it's a beautiful house, right? We want to make sure that we are paying for what we're getting return in value. Stocks work the exact same way. The better everyone expects a company to become, the more expensive that stock is today. When expectations become unrealistic, even excellent businesses can disappoint investors. So be careful of the behavioral trap. This is where the psychology becomes really dangerous. When everyone around us is talking about something, we feel like we're missing out. In behavioral economics, same thing as social media, we call it FOMO, the fear of missing out, right? We begin thinking, if I don't buy this now, I'll regret it forever. That emotion causes investors to abandon their long-term plans. And ironically, the biggest risks often feel the safest because everyone else is doing them. We feel comfortable as long as we're in a group. As long as we're in a group of people that are doing the same thing, we don't feel like it's as big a risk. Meanwhile, the smart investing decisions usually feel boring. And they are. Diversification, not exciting. Rebalancing, it's boring as heck. Tax management, not something people love to dive into because it's boring. Staying invested, none of these make headlines. Yet they're exactly the things that historically have created wealth long term. And they're the things that we focus on here at Synergy, making sure we're making good long term decisions and avoiding the hype and the excitement. So remember the headlines. Think back to the last 20 years. Every few years, there's always something that comes up that investors are convinced they must own. They must own or else they're going to miss out. And it could have been internet stocks in the 90s. It could have been housing in the 2000s. Oil is another great example. Cannabis really took off in 2015, 16, 17. Got a lot of calls about that. SPACs in 2021, 2022. NFTs, remember NFTs? Geez, people were buying digital pictures and paying huge prices for them. Meme stocks, cryptocurrencies, artificial intelligence. Now, even certain IPOs such as SpaceX, Jersey Mike's, anything that's coming down the pike that looks exciting and looks interesting. Same human behavior, but the headlines change. Human psychology doesn't. What we tell our members here at Synergy usually surprises them. First of all, when somebody reaches out and says, I want to get on the SpaceX IPO, what do you think? We don't even make a recommendation. I'm not going to tell them it's a good idea or a bad idea. We tell them we're not recommending on individual stocks or IPOs. If they want to make any investment, they can make that on their own. We're not gambling here. That's not what we do. We're investing. And there is a difference. Our members aren't trying to win Wall Street, at least the way we're working with them. We're not trying to win Wall Street. We're trying to retire confidently, though, and they're entirely different goals. So what if I really want to buy an IPO now and I want to hold on to it because I really love the company? Is that bad? Is that a problem? And the answer is, of course, it's not a problem. Of course, you can do that. We're not saying that every IPO is a bad investment. Clearly, history is littered with great IPOs and great companies that have gone public and eventually made the people that bought the IPOs very wealthy. But we want to make sure that you put it in the proper context. If you absolutely want to participate, keep it small. Think about it as entertainment, not retirement planning. If losing 100% of the money that you would invest would significantly change your life or your retirement, then the position is too large. Invest within your means. Treat it as a night at the casino. If I lost $200 at the casino, I'm not going to be too upset about it. If I lost a couple $1,000s investing in an IPO, I will not be too upset about it. Any more than that, you shouldn't be investing. Speculation belongs in the fun money bucket, not the retirement bucket. And just remember, every time you do that, every time you buy an IPO stock hoping to make a lot of money, there's an opportunity cost associated with that. So what is an opportunity cost? An opportunity cost means I am doing something with my money, as an example, buying an IPO stock, buying SpaceX, and that's money that is not going to be used to build my long-term wealth and compound it over time, over actually decades. So if I take $10,000, maybe I have $1 million or $2 million invested, and I'm going to take $10,000 and invest it in SpaceX because I want to get involved in the excitement. You got to remember that $10,000 is not going to compound for the next 20 or 30 years. And if SpaceX doesn't do well, then that's a lot of money that we're going to be missing out on over the rest of our lives. So that is what our opportunity cost is. And if you're comfortable with that, then go for it. When we study retirees who become financially successful, very few got there because they picked perfect stocks. Very few got there because they just got lucky or did a great job with one. Instead, they succeeded by being consistent, making hundreds of smart little decisions, saving consistently, managing taxes, avoiding emotional mistakes, keeping investment costs low, diversifying, staying invested during difficult markets, optimizing Social Security, managing retirement income, planning distributions, coordinating taxes. That's what builds financial independence, not guessing which IPO CNBC is talking about this week is going to be the big hit going forward. So leave the excitement at the table, focus on the boring, focus on the things that are going to actually accomplish the goals that we're going after. And I'll leave you with one final thought as we wrap up this podcast. Wall Street makes money when investing feels exciting. Successful investors often make money when investing feels almost boring. Excitement sells, but discipline is what actually builds your wealth. The companies making headlines today may eventually become incredible businesses. Some absolutely will, but that doesn't automatically make them great investment at today's prices. The best investment decision isn't asking, what's everybody talking about? It's asking, does this decision improve the probability that I'll achieve me and my family's long-term goals? That's the question we try to answer for every member that walks through our doors. In closing, thank you so much for joining us on the episode of the Retirement GPS podcast, where we're talking about IPOs. If you like us and you want more great content here, make sure that you're smashing that like button. Make sure you're subscribing so you're getting all the new content into your inbox every single week. Every Tuesday, you'll have a new episode talking about a new topic related to your retirement. And go on our social media sites, read our blog, make sure that you're staying engaged because there's some great content there and you want to make sure you don't miss out. If you'd like to learn more about how we help families coordinate investments, taxes, retirement income, and long-term legacy planning, visit us at www.zenergyretirement.com. Until next time, keep learning and keep planning.
Thank you for listening to Retirement GPS, navigated by Zenergy. To explore today's topic further, visit our blog Mile Markers at zenergyretirement.com/blog, where we offer detailed strategies, examples, and downloadable tools to support your retirement journey. Follow us on LinkedIn, Instagram, and Facebook at Zenergy Retirement Planning for weekly insights, checklists, and planning reminders. If you found this episode helpful, please subscribe, leave a 5-star review, and share it with someone planning for their future. Until next time, keep navigating toward a confident retirement. This podcast is for informational purposes only and is not intended as investment, legal, or tax advice. Listeners should consult their own financial, tax, and legal advisors before making any decisions. Zenergy Retirement Planning is a registered investment advisor located in Red Bank, New Jersey.